There are differing views when it comes to the impacts of climate change. So how does one model climate change where such a diverse set of opinions actually exist? Gentlemen, great to have you on the program. Thank you so much for joining us. We know that the corporate environment, the private sector is starting to prepare for the impact of climate change. A lot of corporates are already experiencing this. But how does it actually impact the finance world? Does it have a place, Kobe?
Eleni, I think the biggest issue that you've got in climate change at the moment is that it's a debate that's happening at political level. And then with that, you've obviously got a whole bunch of policy units that are obviously debating with government as far as these things are concerning. I mean, that's a lot of what we saw at COP17 happening in Durban. And before that, you know, the Kyoto Protocol was a net result of also this kind of debate happening. But when you talk about the world of finance, apart maybe from, you know, maybe the carbon credit market that's maybe been created, what else has been happening in the finance world in order to price and understand specifically the risks that are associated with climate change? I don't think much has happened.
Roland, it all comes down to data at the end of the day. With the lack of data, I mean, how does one then price in for potential risks?
You see, if you look at it from a corporate perspective, a company, you know, a petrochemical company, a retail company, all of these companies to some extent are affected differently by climate change and the economy as a whole. So electricity prices might be affected, weather patterns can change the cost of food. And I think from a corporate perspective, a lot of the companies need to price that in. In other words, they need to understand how that's going to impact their income statement and their balance sheet. And in order to do that, you need data. It's very unusual for accountants and financial people to use weather patterns as inputs to their models, but we have to start looking at this. The data is, some data is there, but it is still very lacking in terms of specifics like correlations and the traditional kind of variables that we're using in
Well,
pricing.
the major catastrophic environmental effects of peculiar weather patterns can actually be looked at from an insurance perspective. Would that be one way of collecting data?
Well, there are two types of data. There's regular data, or data that we can measure on an ongoing basis. So levels of, you know, temperature, rainfall, those kind of things obviously can be captured and modeled. But calamity is a totally unexpected kind of variable. So when it comes to earthquakes and floods and these kind of things, which seem to be happening perhaps more frequently, we don't have the data, and we need very long-term data. So insurance companies have been looking at this data, but it takes hundreds of years sometimes to get enough data samples to even draw a conclusion from.
I want to put a span in the works here. I want to quote here, Robert Litterman writes in the Financial Analyst Journal. He quotes two economists, Frank Ackerman and Elizabeth Stanton, and I just want to read this quickly to you. It says, recent scientific research has deepened and transformed our knowledge of climate change. The Earth's climate is a complex, non-linear system with dynamics that cannot be predicted in detail, including, among other hazards, the possibility of thresholds at which abrupt, irreversible transitions could occur. And that is exactly the problem with climate change, is that the events that potentially could occur from this point forward could either be a calamity on the one side, and on the other end, it might be very, very small changes. And I mean, if you just look at all the debates around climate change, COP17 is a great example of this, is different scientists talking about how bad this potentially could be. And this is the problem that you've got in finance. Finance likes data. If once it's got data, it can kind of put probability curves together. It can show you the tails of a probability curve. It can understand, you can start understanding where's most of the events going to occur and where's least of the events going to occur. And without that kind of data, how do you model for something like this? Well, I mean, there is a change to this, obviously. And that is that if we all wake up tomorrow morning and all sea levels have risen by a meter and 3 reinsurers fall over, well, there we go. Now you got data. At least now you understand the nature of the beast that you're proverbially dealing with. But without that, how do you actually price for something like this?
Well, we have to do something, because the governments are going to increasingly force companies to look at this. So from a regulation perspective, there's going to be increased pressure. And also, the companies can benefit from this through tax incentives and things like that. By becoming more environmentally friendly, they will get, you know, these kind of credits that they can maybe sell on into the carbon credit market or whatever it is. So there is a financial element that is coming into it. So we have to do something, right? So is there going to be more guesswork because of the lack of data, or are we just going to wait and see as things evolve.
I mean, I want you to quickly look at your screen, maybe just for 1 minute, just quickly. You'll see that the factors influencing debate on climate change has really got to do with 4 things. The first is a disinterested public. I think the public for now is pretty much detached from the actual debate that is happening around climate change because you can't really see the change on your life yet. Opposition politics, that's the other thing that's kind of driving this process at the moment. Remember that opposition politics, there's people who potentially want to be in power and hence might actually circumvent a process or might actually try and improve a process along the way, and that potentially could influence this. Unknown future catastrophes, that's the other thing. We don't actually know how bad this is going to be. And then the 4th one, imperfect economic modelling. And I mean, Ronald, one of the things that are being used at the moment is what we call the standard constant relative risk aversion utility. And I mean, one of the big input parameters there is what we call intertemporal substitution, which in essence means we're sitting at a point today and we're deferring expenditure, we're deferring the use of something, okay? Because we can, in a linear fashion, understand why we're doing this because we can understand the future. Now, this is one of the shortcomings as far as it's concerned, and I know that economists are utilizing what we call CRRU type factors in order to understand climate change and maybe to try and model for this. But it's kind of it's not a perfect answer.
The problem is that you have to try and quantify something, and typically there is a price or a financial reward for consuming something now versus delaying that consumption into the future. Now, in the traditional economic sense, you would consume resources or natural resources or whatever your company is trying to produce. Whereas with an environmental kind of consumption, it's very different because we can't even measure the carbon footprint necessarily of the company. So you're now getting institutions that are going to be starting to measure, like a credit rating agency, how environmentally friendly that corporate is, and they can use that as some kind of benchmark in the same way that these bond ratings work, which are very subjective to some extent.
Because that's such an interesting point. When we do see a government starting to price in carbon footprints of various companies, then it'll be quite telling with regards to some of the dirty industries that we of course host in the country, such as mining, coal mining and so forth, especially the likes of Sasol, for example. But you've also got banks that are saying that they're carbon neutral, which is quite a fascinating argument, given the fact that banks are financing a lot of the dirty industries here in South Africa. So can they really say that they're carbon neutral? So all of these risks can actually be put together and said, well, what kind of data can we actually extrapolate from the overall scenario that is playing out, and can we actually become carbon neutral down the line?
And where does your responsibility end as a corporate? Because you might be doing banking, but your reactions or your interactions with other corporates is causing perhaps further effects or externalities, as economists call it, that are you accountable for or not? We're not sure.
You see, most of the work, if you think about it like this, is in the finance world has happened around what we call the carbon credit market and trying to create demand and supply around the carbon credit market. Eleni, you mentioned it just now, trying to be what we call carbon neutral. And some of the banks have obviously stated that they're carbon neutral. That, though, is a market, though, that kind of is a carbon, and it's a carbon market. But on the other end of the equation, how does a bank protect themselves and their balance sheets from a complete calamity, for instance, happening?
An environmental calamity.
An environmental calamity happening. Let's assume there's environmental calamity happening, and I've got a bank, and I've exposed hugely to, say, for instance, 10 businesses who in one foul swoop all go belly up. And all of a sudden, I'm exposed to these businesses. What happens to me as an organization? And that portion, finance, I don't think, understands to this degree because predominantly there's just no data.
Because actually, at the end of the day, the first point of call is you need to protect the data that you have, and obviously also the money that you've got as well. Data, we know they're moving into virtual spaces, so it's not just about having databases, for example, and then obviously money, which then you'll have to ensure that it is in a very safe place or vault that won't be hurt or impacted.
It's not just physical assets, it's also just exposure, because you are lending money to a business that can't pay you back because their whole business model goes under because of a flood or some major calamity. And that risk pricing, I think, is what Kirby is referring to, needs to be focused or needs to be addressed a lot more. And we're trying to do that. There is a lack of data.
Robert Litterman's paper ends off by saying climate change should be priced more appropriately. Much of the work that's kind of been happening around pricing climate change, there isn't enough work that's been done. And maybe it should be priced at an appropriate level so that everybody understands the risks actually involved with climate change. The question though is once that happens, that's going to impede on business, because it'll impede the way in which business operates. Think about a bank, think about a financial services organization. It'll impede on the way in which they operate, it'll impede the way in which their balance sheets operate, and potentially couldn't necessarily harness earnings in the degree that they potentially could harness earnings at the moment.
But we also need to think about the companies that could be contributing to climate change, which of course are going to have an impact down the line, because you were alluding to it a bit earlier, Kobe, that the actions today obviously will be paid for tomorrow. So the consequences thereof, we see it in the mining sector. We've got legacy issues with regards to water, as an example, which is creating a lot of havoc from an environmental perspective. That also needs to be priced in, because then as an investor, if you're buying into a mining company that could be hit with a massive tax down the line, then obviously you'll be impacted as well.
And the key question in this area is, do you tax or price heavily now to sort of safeguard your future, or do you delay that pricing to get everyone to get used to it into the future when you start turning on the screws? And that has a major impact on how we manage it. I think if we delay the taxing is maybe a strong word, but if we delay the cost implications for too long, we might get to a point of no return where we actually too late to save the planet because we haven't penalized people early enough, or do we do it right now and hurt the economy?
You see, and this is the problem with the economic modeling, is that if you're delaying consumption today for a future benefit, exactly what does that future benefit look like? You see, in normal markets, I can tell you what the benefit could potentially look like, and you could work and you could calculate it because there's data, but what does that benefit look like? And unfortunately also, from a climate change perspective, much of that benefit will be enjoyed by future generations. Now, quite frankly, that's why you can see, a public kind of sitting back and going, exactly what does this mean for me? Why is this important to me? And you've seen much of that happening in the corporate world as well, where much of what has happened is they've reluctantly come to the party over many, many years. And I mean, yes, we're seeing the carbon credit kind of market, for instance, happening and being utilized. But what about beyond that? What does that look like?
Because, I mean, obviously there's an incentive from a carbon credit perspective, but that's also in the firing line, given the fact that Europe is also experiencing, in a sense, a liquidity crunch, and carbon credits have dropped quite significantly. You're saying that we need to
on a priority list.
Absolutely. We need to move beyond that. And what I find fascinating is the private sector is starting to experience the impact of climate change. Water consumption, for example, a company like Coca-Cola is already starting to experience effects of this, and this is why they're embarking on water recycling. There's a lot of other companies that are starting to become far more cognizant of it. So perhaps private sector is moving far ahead of the financial market or industry, would you say, Roland?
I would hope so. I think the big problem is still, I don't know what my carbon footprint is as a person, and I don't think many companies know what their carbon footprint is as a company. But I do think that the tools and the agencies or the independent kind of assessment of this needs to be ramped up, and people are doing a lot in that space, because only once we can measure what impact we are having on the environment can we do something about it, and I don't think we're there yet.
Yeah, no, I mean, I fully agree with that. There's nothing like a calamity that kind of clears the mind and makes people focus. And maybe at some point something like that will happen, and companies will then quickly reorganize themselves. You see, I want to say something, what Roland said just now, and just want to add to that and say that there are certain corporates who are in the direct firing line for climate change. And those companies are making great strides in trying to become what we call renewable, so to speak, looking at renewable energy sources and so on. But for the big kind of financial services organizations, what are they doing as far as their balance sheets are concerned? Protecting themselves, understanding what all of this means to them, and that's what financial modeling is about. At the end of the day, is trying to understand kind of the risks to these individuals.
Are we on the path to getting that kind of new financial model in place? Do you think that it is starting to become priority?
Well, you've got two choices from a statistical perspective. And Roland, help me out. You're the statistician here. You're either going to use the utility functions in order to understand risk, which has got something to do with a human element that you're kind of adding to that. And most humans are kind of sitting back and going, what's my role in this? I don't have a role in this, And then on the other end, if you don't have data, so to speak, if you don't have that, you're going to have data. So we don't have the data. So what other ways are there potentially to price this? Well, as Rob Litterman quite prudently says, maybe we should just price it at its highest level. But that has an earnings implication. It has an implication to how business operates. And maybe that's also not the ideal answer.
Well, then give us an example of how we could actually price it in.
Well, I mean, let's look at
What form would it look like, and how would it then be reported on with regards to the earnings?
We don't know the exact answer to that yet, but let's just look at a financial case, in other words, ignoring environmental issues. So what is the right price to pay right now to get the returns from the equity market going forward, given that you want to obviously have to take risk? But how much risk do you want to take, and what are you willing to pay for that risk, for the payoff that you're going to get from that asset class called equities? Now I ask the same question on the environmental side. What is the right price to pay today to live comfortably and accept the risks, the environmental risks that are going to affect us, and price that correctly? In other words, if we misprice that and the calamity takes us out financially, then we have a problem. So understanding that is an incredibly complicated problem.
Isn't a carbon tax then the easiest way to price in?
What I like about the carbon tax is there are many market participants, and it's a secondary market. So there is a fair kind of pricing mechanism, but you still have to value the future environmental impacts on those specific carbon credits.
No,
I'm sure that money
it tells you
actually
nothing
flows
about
through
calamity.
to renewable energy, for example, or it moves towards the environment.
Yes, no, absolutely. And I mean, that's, and who knows if that's happening at this stage. I mean, the issue for me is that pricing calamity and actually just making use of some mechanisms in order to become neutral, those are two very, very different factors, to speak. I mean, coming back to Roland's answer just now by saying, what is, and it's what we call the equity risk premium puzzle, so to speak. What is the price that you're prepared to pay today in order to get this future benefit? Number one, I think it has to be applied to different industries in different proportions, because all industries are different and all companies are different. Because if you universally try and apply this, then you can't get to an answer, because everybody's different and all companies are different. What is this return that you require? What is this?
So you want to break it down into smaller
We
problems.
shouldn't get
You're gonna
sticky
have
about
to.
paying things for the future, because we're doing that now by paying off government
Okay,
debts.
but your problem is
for the future. So we're doing it anyway, but in different aspects.
But-
But when it comes to climate change, people get very
Yeah.
sticky about it, say, well, what's in it for us today?
The difference is that we understand what the debt number actually looks like.
Yeah.
So we can actually put a number to it, and we can understand the steps that we need to take in order to make a difference as far as that's concerned. Whereas when you look at climate change, that the actual outcome isn't actually known. The calamity is not known. How big this thing or how small this thing potentially could be into the future isn't actually known. And therefore nobody understands the price quite to pay. And then on the other side, you're sitting with a public which is just disinterested and saying, why is this my problem?